This is a
So
micro point that I would love to unpack, actually. Just this comparison between the stock market and your cash flow investing, because we were texting about this a little bit. To me, when I look at the stock market, I look at it as like this lazy portfolio. Like you said, long. A lot of people try to time the market. Oh, I'm going to buy, during this next crash and all this kind of stuff. But if you're really looking long, 10, 20 years, and your idea is to get to a point where your portfolio is something that you can passively live off of, versus the style of cash flow investing that you do, how do they compare? How are you, because to me, isn't there, I didn't realize that the way you go about your cash flow investing is that it is a long-term deal where you're not touching things. I thought these were like perhaps little 2-year, 3-year deals, and then you need to shift into the next deal afterward. Can you unpack that a little bit?
sure. Yeah. So with the stock market, I am a fan for a long-term type of play. I do think the U.S. overall is going to do a good job. I don't think it should be the first investment.
Mm-hmm.
It can be. It most certainly shouldn't be all of your investment. That's just too much,
Mm-hmm.
concentration risk, in my opinion. But to me, I want exposure to assets that are going to grow. So I like owning assets because as money, as our supply expands,
Mm-hmm.
monetary supply, assets expand. Meaning,
Yes.
when the Fed prints more money, the assets that I own will grow in proportion to the amount of money that the Fed is printing.
Correct.
If I don't have assets, then I'm losing purchasing power. If I'm sitting in cash, my cash is being diluted. It's becoming
Mm-hmm.
less. And so I want to own assets. Now, one of the strategies that I use is I really like to invest in things and negotiate or utilize structures that allow me to pull my principal out quickly,
Right.
but still have long-term upside. So
Mm.
you can do this a lot in real estate where you make an investment, let's say of $100,000, and it's in a value add property. Let's call it an apartment complex. All
Yes.
right. This apartment complex, they rehab it all, they increase rents, they get, new tenants in, or they just increase the rent if there are plenty of people in. Technically, I love when projects have like 90% occupancy and they
Mm-hmm.
literally just do it, unit by unit while there's still cash flow and you're just, flipping people in and out. It's a lot easier to maintain it. So
Mm.
now you can go to the bank, you can refi that property, you can pull a whole bunch of cash out, you pay all the investors back. So now as an investor, I'm made whole. I got all my money out. I did so in a year to 2 years.
Mm-hmm.
And I made a return on that money because generally there's a preferred return associated with it. So I've got all my money out and I made, let's call it an 8 to 10% return on that hold of my money.
Mm-hmm.
But I still have equity in this investment. And this might be a 10-year hold, a 5-year hold, maybe it's a forever hold. And I'm going to earn distributions based on my equity in a pro rata basis. So I
Mm-hmm.
have all my money out of the deal. I still have equity. And now I can take that same money and invest it in another deal where I
Mm-hmm.
can get cash flow and then I can get more equity. And when that is refied, I can pull it out. I can do this same thing in a debt vehicle. So let's
Right.
say that there's a debt investment and I say, hey, I'm happy to do this debt investment, but I don't want to do straight debt. I would like to, I'd like to have some sort of an incentive, a kicker, an equity kicker that I don't pay
Mm-hmm.
for. I just want it to be a perk of me giving you a loan. And
Mm-hmm.
so I get these all the time. And
Hmm.
I'll get equity in a company. I'll have all my money out. Maybe it's a 1-year note. Maybe it's a 6-month note. Maybe it's a 2-year note. I generally don't go longer than 3 years because I want my money back as quick as I can,
Yes.
that initial capital, because
This is
that
one
I'm
of
going to
your, sorry to jump in,
compound.
but that's one of your commandments, right?
Yes, it is. Yeah. Yeah. The fourth commandment is get your principal back quickly.
Mm-hmm. Mm-hmm.
Immediate return of principal. And so the quicker I get that back, the more investments I can get into. I can take the same money and just have it compounding in equity positions in several different investments that together hedge my risk.
Right. Right. Oh, this is so
But
good.
there's very little risk, Armand. If I have all my money out of the deal, even
Mm-hmm.
if it tanks, I
Yeah.
still
What
have
did you
my money
lose?
back. I still made a
Yeah,
positive return. So it's all
absolutely.
upside and it's all house money.
Right. Right. It's like a little cherry on top.